Imagine you want to buy a house. It's a big decision and requires a significant amount of money. You need a lot of money, more than you might have saved up. So, you decide to get a loan from a bank. The bank gives you the money you need, and you agree to pay it back over time with interest. A bond works in a similar way to a loan. When you buy a bond, you are essentially lending money. You lend money to a company or the government. They need funds for various projects, like building infrastructure or expanding their business. In return, they promise to pay you back the amount you lent, known as the principal, at a future date. Additionally, they pay you interest at regular intervals. This interest is your reward for lending them the money. Think of it as an IOU. You give someone money, and they give you a bond as a promise to repay. They promise to pay it back with a little extra, which is the interest. This extra amount, the interest, is what makes bonds an attractive investment. Bonds are a way to invest your money with relatively lower risk compared to stocks. They provide a steady income stream through interest payments. Bonds are like pieces of a big loan. When you buy a bond, you're buying a piece of that loan. Many people can buy these pieces, making it easier for companies and governments to raise large amounts of money. Each piece is a bond, representing a portion of the total loan. Bonds are bought and sold in the market, just like stocks. Investors can trade bonds to take advantage of changing interest rates and market conditions. When interest rates go up, the value of existing bonds typically goes down, and vice versa. This is because new bonds are issued with higher interest rates, making older bonds less attractive. It's important to understand the terms of a bond before investing. Factors like the interest rate, maturity date, and the creditworthiness of the issuer can affect the bond's risk and return. Diversifying your investment portfolio with bonds can help manage risk. Bonds often perform differently than stocks, providing balance during market fluctuations. Many people invest in bonds as part of their retirement planning. The steady income from interest payments can provide financial security in the long term. In summary, bonds are a way to lend money to companies or governments in exchange for regular interest payments and the return of the principal at maturity. They offer a relatively stable investment option with predictable returns. Please like and subscribe.
Companies need money to grow. They might need to build new factories, invest in research and development, or expand their operations into new markets. All these activities require substantial capital. Governments need money for projects. These projects can range from building new roads and bridges to funding public services like schools and hospitals. They also need funds for defense and other essential services. They issue bonds to raise this money. Bonds are essentially loans made by investors to these entities. In return, the entities promise to pay back the loan with interest. When you buy a bond, you become a lender. This means you are lending your money to the company or government in exchange for periodic interest payments and the return of the bond's face value at maturity. You lend them money for a specific time. This period can range from a few months to several decades, depending on the bond's terms. This is called the bond's term or maturity. The maturity date is when the borrower is obligated to repay the principal amount of the bond. The borrower promises to pay you back on the maturity date. This promise is a key feature of bonds, providing a predictable return on your investment.
Bonds have a fixed interest rate. This rate is determined at the time the bond is issued and remains constant throughout the life of the bond. This is called the coupon rate. The coupon rate is the annual interest rate paid on a bond's face value. You receive interest payments regularly. This is typically semi-annually. These payments provide a steady income stream, making bonds an attractive investment for those seeking regular income.
When you decide to invest in a bond, you start by purchasing it at its face value. This face value is essentially the amount of money you are lending to the bond issuer, which could be a corporation, municipality, or government. Over the term of the bond, you will receive regular interest payments, which are typically made semi-annually or annually. These interest payments are known as coupon payments, and they represent the return on your investment. When the bond reaches its maturity date, the issuer is obligated to return the principal amount to you. This principal amount is the face value of the bond, which is the same amount you initially invested. By doing so, the bond issuer fulfills its promise to repay the loan. For instance, if you purchase a $1,000 bond with a 5% coupon rate, you will receive $50 in interest each year. This means that over a 10-year period, you will have received a total of $500 in interest payments. At the end of the 10 years, the bond reaches maturity and you will get your $1,000 back, completing the investment cycle. Bonds are a popular investment choice because they provide a predictable income stream and return of principal, making them a relatively safe investment. It's always a good idea to consult with a financial advisor to understand the risks and benefits associated with different types of bonds. There are various types of bonds available, including government bonds, municipal bonds, and corporate bonds, each with its own set of characteristics and risk levels. By making informed decisions and understanding the terms of the bond, you can effectively manage your investment and achieve your financial goals. Governments issue bonds to fund projects. These projects include roads, schools, and defense. Government bonds are considered low risk.
U.S. Treasury bonds are an example. They are backed by the government. They are considered very safe. Treasury bonds have different maturities. These range from a few months to 30 years. The longer the maturity, the higher the interest rate.
Section 5. Corporate bonds. Investing in businesses. Companies issue bonds to raise capital.
They use this capital for expansion, research, or operations. Corporate bonds offer higher returns than government bonds.
However, they carry more risk. The company could face financial trouble. This could affect their ability to repay the bond.
Corporate bond ratings indicate risk. Higher ratings mean lower risk. Lower ratings mean higher risk. Investors demand higher returns for riskier bonds.
Section 6. Municipal bonds. Supporting local communities. Local governments issue municipal bonds.
They use these bonds to fund local projects. These projects include schools, hospitals, and infrastructure.
Municipal bonds often offer tax advantages. The interest income may be tax-free. This makes them attractive to investors in high tax brackets.
Municipal bonds support local communities. They provide funding for essential services. They also offer investors a way to make a difference locally.
Section 7. The allure of bonds. Stability and predictability. Bonds offer stability and predictability.
They provide a fixed income stream. You know how much interest you will receive and when. This makes them suitable for conservative investors.
Retirees often invest in bonds. They need a reliable income stream.
Bonds can help diversify your portfolio. They can offset the volatility of stocks. A well-diversified portfolio is essential for long-term financial success.
Section 8. Bonds versus stocks, a matter of risk and reward. Stocks represent ownership in a company.
Bonds, on the other hand, represent debt. Stocks offer higher potential returns than bonds, but stocks are also riskier.
Their value can fluctuate significantly. Bonds are generally less volatile than stocks.
The choice between bonds and stocks really depends on your risk tolerance. Younger investors may prefer stocks, while older investors might lean towards bonds.
Section 9. Bonds and real estate. Diversifying your portfolio. Real estate is another popular investment.
It can provide rental income and appreciation. However, real estate is illiquid. It can be, challenging to sell quickly.
Bonds offer more liquidity. You can buy and sell them easily in the market.
A diversified portfolio should include a mix of asset classes. This can include bonds, stocks, and real estate. Diversification helps spread risk.
Section 10. Bond pioneers. Learning from the best. Benjamin Graham was a legendary investor. He emphasized the importance of bonds.
He believed they provided a margin of safety. David Swenson managed the Yale University endowment and achieved remarkable returns.
He allocated a significant portion of the portfolio to bonds. These investors understood the role of bonds.
Bonds can provide stability, income, and diversification. They are an essential part of a well-rounded portfolio.